We woke up to news today this Wednesday morning that another truckload carrier had closed its doors, this time abruptly. HVH, a Denver-based carrier, had just shut down. Craig Fuller joins me now, and we talk about this way too often.
It is a sad day for the employees, customers, clients, and really anybody, stakeholders, anybody associated with this company. They've shut their doors.
344 trucks. That's a lot of trucks on the road, a lot of people without jobs now. Why does this keep happening? I feel like we just keep doing this and keep talking about this.
Well, we do keep talking about it because it keeps happening. This is the 8th major bankruptcy this year. We've seen about 3,000 trucks leave the market. More importantly, thousands, 5,000 to 10,000 jobs have been eliminated from these carrier pools as well, because you got to keep in mind, is not only that there are 320 trucks associated with it, but there are also a ton of operational support folks, mechanics, and people that are dependent upon the company. And then bankruptcies, what also happens is that all of the debt, all of the vendors that serve these companies get wiped out potentially in this exit. And so there's a lot of downline residual impacts that go well beyond just the company itself.
So HCI Equity had a huge stake in this. Why do private equity companies not have success with these truckload carriers?
Well, we've seen this before. So earlier this year, Falcon closed, and it was a private equity-backed company. It shut its doors because private equity is all about getting financial returns. Mm-hmm. So they make investments with the hope and anticipation that that investment is going to grow in value over time, and at some point they have to exit. The challenge is that a lot of times private equity uses debt to actually fund these transactions, and so they load up the companies when they acquire it full of debt. They sometimes pull the cash out of it. We saw it with Sears, sort of a broader, Toys R Us and Sears are both the same thing, as the private equity companies load up these, in this case, trucking companies with debt, and then they pull money out in service fees, maintenance fees, management fees. And so effectively what they're using is the company's cash flow to fund their returns. The challenge is that the company in those processes are underinvested and underfunded. And it works so long as the financial health of that company is well. But in a market like 2019, where we had really tough conditions, it's hard to do that. It's hard for that to be sustainable, especially if you're piling on debt continuously, which is really likely what happened here.
And not just a money issue. I know a lot of other truckload carriers, some of them said insurance rates were too high. Others couldn't pay their fuel bills. There's a lot of things, and you mentioned 2019. This has not been a great year for trucking. You have a chart here. Kind of what are you showing on this chart?
Yeah, so this is operating ratio, and one thing I want to talk about private equity is unlike some of the bankruptcies where these have been owners that have shut down their company. We've seen multi-generational family businesses shut down. This was a private equity transaction, which meant you had institutional money. So it was a much more financial-driven decision than it was a family-driven decision. So just a little bit differences. But regardless of that, everybody's facing the same market right now. And this is our operating ratio metric, which actually measures the operating ratio for the industry, or the averages for the industry. And the thing to keep in mind in the operating ratio is it's inverse of profitability, is the way to think of it. So anything above 100 is actually bad.
Okay.
Anything below 100 means that you're making a little bit of money to pay your debts, to pay your taxes, to pay any of the other, pay your own distribution. So you want to have a low OR. So companies like Knight, Swift, and Heartland, they have operating ratios that are in the 70 because they're immensely profitable relative to the industry. A lot of carriers are operating in the 90s, which is not good. If you're operating over 100, you're unlikely to survive long term because you can't do that indefinitely. You're going to have to continue to fund your company. This is the average taking the TCA's data. The Truckload Carriers Association has brought together 220 fleet profiles made up of about 130 trucking companies that feed in general ledger data, so financial data coming from their financial systems, and they provide it monthly to see how they're doing compared to their competitors and compared to the market. We've then aggregated that data across all those fleets and created an anonymized, aggregated index so we can see what's happened in terms of broad trends. And I think this is really interesting. If we go back to 15, so there's a lot of discussion about the freight recession that happened in 2015 and 2016. And so everyone talks about how soft it was, how tough it was, and it really was. But what's interesting about it is you don't really see companies, the average in the market, go into negative operating ratio. And the reason that you can have a quote unquote freight recession but not have negative operating characteristics is because you didn't have the higher costs. So fuel costs were relatively low, driver wages were kept in a band. There was a lot of sort of favorable outcomes in terms of operating profits and revenues that benefited the carriers back then. And so even though we had tough conditions in 15 to 16, you can actually see it right here. So anything red or above this line is as a high operating ratio of 100. That means they're in negative territory. They're losing money. So you can see it back here. It's green. So we didn't see, as an average, the truckload dry van market go into negative territory. We did see it in 17, a little bit of negative conditions right here. It's probably a reflection of, even in 17, you had softer conditions. You saw it peak up about mid-year. You had a little bit in the fourth quarter, but not dramatically bad. But let's go into 18. 18,
it's a lot of green.
See how low that is?
Yeah.
That is immensely profitable. I mean, you were down in the low 90s as an average, and we haven't seen that for a couple of years. And so 18 was really, really good. Now, keep in mind, this is an average of 220 trucks, 220 fleet profiles. And keep that in mind, it's 70,000 trucks. So approximately 20% of the for-hire market is represented.
So these are all different fleet sizes we're looking at, all combined into one chart?
Yeah, these are all fleet sizes, dry van market. It's a significant representation. It's not 20%, it's about 10% of the for-hire dry van market. But anyway, so we look at this, we were actually saw significant progress being made in 18. Everybody was making money, talked about great conditions. But I want to look at 19 because 19 is really, really interesting. What we see is in 19, we're moving up.
Yeah.
So bad conditions. This red is really, really bad. We're above 100. Carriers are not making money, and they didn't show any level of progress up until the second quarter. But it wasn't great. Like, even where you're right here, you're at 99.578. That's where you finished in July, right at 100%. And I want to keep in mind that you really have to generate at least 2 to 2.5%. So you need to be about a 97.5 OR to really pay your debts on average. Carriers that operate any above that 97.5 have a history of going bankruptcy. It is not sustainable to go below those levels. So if you see levels above that 97.5, over time, if you do that for years, you are likely to file bankruptcy. And what we're seeing right now is conditions, again, the entire year, we've seen it where carriers are not making money. It's very concerning in terms of the health of the industry, and it sort of explains the backdrop of why all these companies are filing bankruptcy, whether they're private equity funded or whether they're funded by families.
This is perfect to see because 99, as you said, is so close to 100. So this is why we're seeing all these bankruptcies. And I'm sure this is probably not the last time we're going to talk about this.
It's probably not, especially because keep in mind, when you accumulate losses, you're taking on debt typically. Whether you're drawing into your working capital that you generated during the profitable season, you're drawing that money out, or you're borrowing money from the bank to pay for your operating losses, you're not making money. So these things become accumulative over time. And so where you see these losses, you can't make those up, that you don't get back the time. And so in trucking, you end up having to cut into your working capital, which over time, if you do that for a long time, will actually end up putting you out of business, and that's what we're seeing. It's really concerning. So this data is live on Sonar. You can get it right on Sonar. It's the operating ratio dry van fleet. We have it for refrigerated flatbed, but it's coming from 200 companies. And here's the thing is these aren't small companies. These are companies from 75 trucks to, I think the largest is 7,000. So you're seeing mid-sized and large and enterprise carriers represented in this sample size. It's the first time we've ever seen the data, first time TCA's ever aggregated the data, bringing everybody together and bringing these KPIs. So it's pretty powerful to see, but I'm really concerned because even where we're talking about conditions being soft, you're seeing it in here, and even improving conditions like we had in the end of July, we still see carriers that aren't making money.